Welcome to YieldNerd, an educational show about how you can acquire and manage yield. Welcome back, Yield Nerds. We are picking up on the next part of our deep dive into Muni bonds. In the previous part, and if you have not watched it, you absolutely need to so you can follow along. We talked about what a muni bond is, what are the kinds of muni bonds, what kind of obligations exist, how do you evaluate a muni bond. Now we're going to go into the yield curve itself, remind ourselves of what the yield curve is, and start looking at the muni bonds yield curve. So let's again go back to the tomato farm and recap that if you loan me money for 3 months versus you loan me money for 10 years, that's a very different risk profile. So you would rightfully want a higher coupon if you were to loan me money for a longer duration. Except we saw that for treasuries, the yield curve inverts at about 18 months. So after you go past the 18-month period, strange but true, you actually get a lower yield with the treasuries than otherwise. And so that in effect is the yield curve, understanding how yield varies with duration. And so keep that in your background. And now we're going to get into the yield curve for municipal bonds. One quick thing before I forget, you may remember treasuries are state and local tax exempt. We also reviewed that agency bonds are state and local tax exempt in some cases, but not in all of them. Let's talk about municipal bonds and their yield curve, and we'll come back to their tax treatment after that. So let's look at the municipal bond yield curve. My usual disclaimers apply. I'm showing you Schwab. I'm not affiliated with them. I'm not endorsing them. In order to go into the yield curve, you would again go into research, and then you would go to bonds and fixed income. Ta-da, right there on the screen, you will see municipals sorted by their credit rating with the AAA or the highest credit rating at the top, and it goes from there towards the AA and the A. That is where the munis are seen. So next we sit and plot the yield curve, and ta-da, we see something very, very interesting. You may remember that treasuries have an inversion. Munis, in some cases, there is a little bit, but in general, munis have a very nice linear pattern. So it seems like you cannot go wrong with munis. You want a higher yield? Just go to a longer duration. Kumbaya, that is perfect. That is exactly all you need to do. You can sell your house and invest it all in munis of various durations, and you are going to win every day, all the time, because there is even an advantage. Munis are not taxed at the federal level, and in some cases, munis are also not taxed at the state level. What are you waiting for? Sell your house. This is the greatest thing since sliced bread. No taxes, all gain, no pain. Munis never fail. How amazing, awesome. And that is not the message. There are a couple of notes on the tax-free thing. Maybe more than a couple of notes. So I would encourage you to pay attention to the next few minutes so you truly understand what the tax-free connotation of a muni really is about. So let's talk about the tax implications of a muni. One quick reminder, I'm going to talk about taxes. I am not your tax accountant. This is education and not advice. So let's come up with this thing that I'm going to call the happiness meter. When you look at the munis, the first thing you understand is munis are generally exempt from federal taxes. And so, kumbaya, on the happiness meter, we are all the way on the far right. That is fantastic. I'm going to be educating you a little bit on even the federal tax side of the house. But for now, let's just say we are super happy. No federal taxes for municipal bond holders. And one more thing for you to remember, just a very, very small thing. If you bought the Muni for $99.80 for a par value of 100, that means you bought it for a discount. If you held it for 3 years, meaning it's a long-term period that you held the Muni, and you got the par value of $100, just know that there is indeed a federal income tax, which is treated as a capital gains tax because you held it for a long term. It's just a small tax there. So when you buy the Muni and you sit there and think, wow, I got this without any federal tax, just want you to know that your after tax income indeed is going to drop a little bit. Your yield to maturity that you got is not the exact keep because you are going to shave off a little bit in taxes. So other than that, what a lovely investment. Happiness meter, you still are on the blue, which sounds pretty good to me. One quick thing I need to add. Well, if you did buy the Muni for $99 instead of $99.80, and you held it for 3 years, and you got the par value of $100. Now your gain is considered significant. This rule is called the de minimis rule. So you could go pick off muni bonds that are trading much, much more of a discount for their duration, and there are specific rules behind it, and there is a 0.25% per year to maturity, that sort of rule. Just know that if you thought there is an enormous bargain of a muni bond that is available, the difference between what you paid and the par value may be taxed as ordinary income federally. So it's not exactly federal income tax free. You actually will end up paying ordinary income taxes on the difference between what you bought and the par value if you are past a threshold called de minimis. So, so far we've seen a couple of really small, a nick here and a nick there, and our happiness meter is still pretty high. So, munis look really good. Did I forget? There is one more thing I wanted to tell you. Uh, Obviously the de minimis rule takes a bite, and then you also saw that if you bought it below par, even if you did not hit the de minimis, you pay capital gains. Uh, I forgot to tell you one other thing. If you bought an Illinois muni bond and you are an Illinois resident, in many states, if you buy an in-state muni bond, state taxes are not levied. Illinois is not one of them. You will still be taxed in state. So you need to make sure when you look at the returns of the municipal bond, you don't assume that you are getting state and local tax free. You will be taxed on state and local tax. So, oops, Illinois residents, don't count that as a tax benefit. And so you need to go back and adjust your yield to maturity. And the after tax yield is actually lower because you no longer have the benefit of the state, tax freak. You may want to go back and check your yield because your after-tax keep of the yield to maturity is not the same anymore. The state does take that bite. So overall, this looks, pretty good in many states. Illinois is not one of them, as I told you. Please check your home state. There are other states where you do get state tax exemption if you bought an in-state bond. So that is something you want to check on. Illinois is not one of them. I forgot to mention one more thing. There are other kinds of bonds called private purpose muni bonds. So, if a famous football team wants to build a football stadium and it's a private entity that is getting the benefit, used to be that you would be able to get state tax exemptions to fund the football stadium. And that loophole has been stopped. And I don't want to call it a loophole. It was something that a state would do because the calculation the state makes is, hey, this particular stadium, or it might be an airport with a lot of private jet landing there, and they may say that is going to bring us prosperity, so we want to raise a bond to build that airport or raise the bond to build the stadium. However, if private business is conducted at that particular facility above a certain threshold, for example, more than 10% of the usage of the airport is for private airplanes, then the connotation is that, hey, we're giving you state bond, state tax exemptions because we thought it's good for the state. If it is good for a private business, we're not going to give that anymore. So that's another little area where it may not be quickly visible, but this is really not state tax free municipal bonds, so you will be paying state taxes on that. One more thing I forgot to tell you. There is something specifically called a private purpose muni bond. It will be labeled as such, and these are also taxable at the state and local level. So what we have seen in all of these happiness meter examples is what started off as a scot-free, no tax at the federal level, no tax at the state level, no tax at the local level. There are all these ifs and buts and becauses, and if you thought there were only 6 Easter eggs that were going to tell you the good news and the bad news, there is one more thing I wanted to tell you. And it's actually a few more things. Depending on your income, there is a concept called the alternate minimum tax, which will actually increase your taxable rate on income from private placement munis. And so if you did one of these private munis, you will pay a higher tax if you hit AMT, and you will have to consult with your tax person to understand what that means, because the actual limit for AMTs are different based on your filing status and deductions and so on. One more thing I forgot. Um, Income from muni bonds also increase your modified adjusted gross income. So some of you may be on Social Security and you say, yay, I bought a muni because this is, I feel good about owning these tax exemptions. Not really. Depending on what your age is, what your Social Security is, a greater portion of your Social Security income may become taxable if income from municipal bonds push you above the modified adjusted gross income limit. And while I'm at it, I might as well tell you one more thing. Depending on what your investment income is, your Medicare Part B costs may also increase if you invest in a municipal bond. Here is the challenge. I've so far rattled off 8 or 9 cases where more bites of the apple are being taken out of what you thought was a free ride. And that doesn't mean muni bonds are terrible and you should run away from them. It just means you need to be far more aware of your tax situation before you take the yield of a municipal bond, multiply it by some number which you think is your tax, and say, yay, I win. That is not the case. There are a lot of things that you have to take into account. And so I would encourage you to be a very educated yield investor when you buy municipal bonds, and that is the entire purpose of this show. So let's actually look at the yield we can get from municipal bonds. So you can then apply your own tax brackets, your own exemptions, your own situations, and see if the reward from municipal bonds as of today, weighed with the risk and your tax status, works out at the end of the day. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.